Hello, Accounting 203 students. This is Professor Hassey. It's week 3. Again, additional discussion of the accounting cycle for our accounting or financial and managerial accounting summer session class. And I welcome you all. Today's date is Wednesday, June 21st. A little late this week. I had to travel back east last weekend. Just got back into town yesterday, Tuesday, so we're a little bit behind, but nevertheless, we're beginning our work for assignment number 2 this week. Assignment number 1 grades have been posted. The solution file is in Blackboard, and I'll explain that to you in just a minute. Today, we're going to talk about chapters 2 and 3, which is the subject of your assignment number 2 work, which is due this Sunday, June 25th. We also will have a discussion forum posted at the end of this week due on July 2nd, which will be you to select a company that you're going to be doing your project paper on. And I'll explain that more in our second video this week. So our pace is beginning to pick up a little bit in our class, and the performance on our first assignment was excellent by all our students, so thank you for that, and we're off and running in our class. Let's take a look at where we stand in our infrastructure for this week. Hey, remember, if you have any questions or concerns about the class or where you stand, again, all the grades are in the report card section on the front page of this Blackboard section. So you should see your grade average through assignment number 1 there. If you need to know how that grade was calculated, you just click on the grade and up will come your own personal grade center with all your papers and all your files returned to you that you submitted and the solutions to those files. So again, if you have any questions, remember we have student hours every Thursday evening from 6 to 8 p.m. And at that time, you can ask me questions, or you can also send me questions or request separate special Zoom meetings during the course of the week. So here we are where we stand right in class right now. We've completed 20% of our grade. We're now working on assignment number 2 this week, which is another 10% of your grade. And then we will begin in next week having you to select a company for your project paper and assignment number 3 next week. But I'm thinking about postponing assignment number 3 for a week and having that due July 9th to give us a little bit more study time on the accounting cycle. So stay tuned for that, and I'll have that decision by the end of this week 3. Just thinking maybe we just need a little bit more time on the accounting cycle, but we'll definitely have discussion number 2 due on July 2nd. So more updates on that on this coming Friday with our weekend update video. But again, definitely this week, assignment number 2, the accounting cycle, where you're doing some journal entries on a file that I have provided, and we'll take a look at that right now. Here's our assignment number 2, where I have given you 3 files. 2 are the work files, the PDF and the Word document. Both are the same file, same information, but in just different formats. And then I've also given you a spreadsheet file. That spreadsheet file is where you'll do all your work on. Okay, the only file you would submit would be your work on that worksheet file that I have provided you. So you'll download that and do all your work on that file. And let me explain to you that right now. Here's the assignment number 2 week work, where we're now actually doing business and recording business transactions. The first part is to record the general journal entries of these transactions, May 1st through May 9th. We'll be looking at a sample of that in our discussion today in our lecture video, problem 2.1a from your textbook. From that, you're going to be posting them to the general ledger that I have provided. And once you have your general ledger posted, then you'll complete a trial balance, a listing of all your general ledger balances, the trial balance. Once you complete that, you'll get to part 2, where you'll prepare the financial statements for that month of May, for the income statement, the statement of owner's equity, and the balance sheet. There's tabs all created, all formatted. All you need to do is put in the accounts and the numbers, and that's all you need to do. Well, that's enough, definitely. But all the work is done on that spreadsheet file, these two parts of assignment number 2. And here's that spreadsheet file for assignment number 2. What you'll do is you download it and you record all your work in this file in these formats that I have provided for you. So you don't have to create these formats. You just put in your information. Again, if you're working on Apple and Apple numbers, you can download this file to Apple numbers, convert it to Apple numbers and do your work, and then submit the Apple numbers. Or you can just submit it in this Excel spreadsheet, which many of you, I think, already have. So I think one of our students uses Apple numbers, which is not a problem. No problem at all. It's easier for me if you do your work in Apple numbers, if you do use Apple, and then once you complete that file, save it as an Excel file and post the Excel file. But it doesn't matter if you post it as an Apple numbers file or an Excel file, that is fine. So there's a tab to do all your journal entries on the appropriate date. Then you take those entries and post them to the ledger accounts, either on a debit side or a credit side, and determine the account balances once you have all these posted. Then you take those accounts and list them, and here they all here are, with whether their debit or credit balance. And remember, the trial balance has to equal. Once you have that trial balance, then you go to the financial statement tab and put in your income statement and income statement accounts, your statement of owner's equity accounts, and your balance sheet accounts for this company for the month of May. And there you go. What we will be working on next week is the adjusting entries and the closing entries of the accounting cycle, and then we'll be completed, and that'll be assignment 3 next week. But now we're concerned with recording business transactions in a journal entry, posting them to the general ledger, reporting those ledger balances in a trial balance, using those trial balances to create the proper areas that they appear in the three financial statements. That's our work for this week, assignment number 2, and we'll look at practice on that in just a moment. So that's assignment number 2. Again, if you go to assignment 1, you can download the solutions for that work. Again, if you go to your grade center, I have uploaded your results of your work to your grade center. You can download it and see which parts you got wrong. Or if you got 100, I don't return your file to you because you got it all right. So again, and if you have any questions on your first assignment, let me know and I'll explain it to you. Here is assignment number 2, which you'll be working on this week. There's the work files there, the explanation files, and then your worksheet that you will do all your work on. You do not need to use the Word doc file or the PDF file to do answers. All your answers are in the worksheet file that I've submitted. And then here is assignment 3 for this week. We'll be talking about journal entries and transactions and our assignments and work that we'll be doing this week and next into our accounting cycle. Okay, we're back. Carla Tanner opened a web consulting business called LinkWorks and completed the following transactions in the first month of her operations. April 1. These are the journal entries to record her business transactions. Where in Chapter 1, we did the accounting equation and we listed the accounts underneath the appropriate area of the accounting equation. Now in Chapter 2, we're recording the general journal entries to properly, in the accounting language, show the increases or decreases in the individual accounts of the transactions of this company called LinkWorks. The company could be Amazon. The company could be University of Laverne. The company could be Hancock College. The company could be the United States Air Force. The company could be Ford Motor Company. Everybody uses general journal entries to record every single business event. Can you imagine how many transactions a day a company like Amazon has? Thank God for computers. So, April 1st, I'm on problem 2-1A, page 74. Tanner invested $80,000 cash along with office equipment valued at $26,000 into the company. So now we have our first look-see at a business transaction that has more than 2 accounts being affected. Tanner invested $106,000 in her company. $80,000 was cash, $26,000 was office equipment. Debit the 2 asset accounts and credit K. Tanner Capital. Again, as I said earlier before break, do not worry about these account numbers 101, 163, and 301. And do not worry about recording, explaining what the transaction is here. Don't have to do that. All I want to see is the date, the account, and the dollars. And the general rule of thumb, it's not a rule, it's not a law, but you usually list the debit transactions over the credit transactions, just to see the flow of the journal. One more time, you list the debit transactions first, the credit transactions underneath that. Now here comes an interesting one. April 2nd, the company prepaid $9,000 cash for 12 months rent for office space. And they even give you a hint. Debit prepaid rent. Now, one thing I can totally 100% assure all of you, even though you all are good looking, very nice, very professional people, I'm never ever going to give you a hint on a quiz or an examination. No hints. You'll have to figure that out for yourself. But let's explain this prepaid rent account. I know I had a conversation with Cynthia in this last week, and she asked a little bit about prepaid. Prepaid is paying in advance for a service. The service is owed you. That's why it's an asset. I'm paying for office rent for 12 months ahead of time. I'm paying 12 months into the future. So I'm paying in advance. Why is this not an expense account? Because I have yet to been provided the rent. I'm paying in advance. So that's why it's called a prepaid account. And that's why it's called an asset account. Debit prepaid, credit cash. We exchange one asset for another. Cash becomes a prepaid.
I have a question. Blanca.
Yes, hang on just a sec, Blanca. See, that's a transaction April 2nd. It has to do with prepaid rent, all right? Then in April 3rd, the company made a credit purchase for $8,000 in office equipment and $3,600 in office supplies. Payment is due within 10 days. So they're purchasing 2 assets, equipment and supplies, and they owe the money. Accounts payable. Notice there's no word of cash in that transaction. You don't see cash at all. That means it's accounts payable. They have to pay the money in 10 days. But they received 2 different assets. Why don't you just put that all into one asset account? Because they're 2 different asset accounts. You're going to be misspeaking or misspoking the books, mislabeling the books if you just put that all into one account. So you have to put it in the 2 proper accounts as indicated. April 6th, the company completed services for a client and immediately received $4,000 cash. Just like we saw in chapter 1. Cash is increased by a debit. Revenue is increased by a credit. Debit cash, credit revenue. Again, do not worry about these dopey account numbers or giving me an explanation of that transaction. You don't have to worry about that. You know, this is where if I was just learning this for the first time, this is where I would put that accounting statement, accounting equation with the debits and credits that we saw before break, and put that right next to me so I can kind of see that and see how that I would do my journal entry based on that type of information. April 9th, the company completed a $6,000 project for a client who must pay within 30 days. They didn't pay us cash. They owe us the money. Owe us the money. Owe us the money. Receivable. Debit accounts receivable, $6,000. Credit service revenue, $6,000. We've provided a service, so it's still revenue. Even though we haven't gotten cash, the service has still been provided. So we've put it into receivable. They owe us the money. April 13th, the company paid $11,600 cash to settle the accounts payable created on April 3rd. Well, remember, on April 3rd, we bought those two asset accounts for $11,600. Here on April 13th, we're paying the bill within 10 days of that original transaction. Debit accounts payable, credit cash. Now the liability is being reduced. We're paying the bill, debit, and cash is being reduced. Writing a check for cash, credit. Debit, credit, accounts payable, and cash. April 19th, the company paid $2,400 cash for the premium on a 12-month insurance policy. Oh, another one of those prepaids again. All right. We're paying in advance for a 12-month insurance policy. $2,400 cash. Debit, prepaid insurance, credit, cash. Debit, prepaid insurance, credit, cash. Just like we did on April 2nd. It was another prepaid, but that prepaid was for rent. This is prepaid for insurance, $2,400. The service of insurance is owed us because we're paying in advance. April 22nd. The company received $4,400 cash as partial payment for the work completed on April 9th. Okay, remember on April 9th, we provided $6,000 of services to a client and we billed them. They owe us the money. Now on April 22nd, they pay us $4,400 of that receivable. Debit cash, $4,400. Credit receivable, $4,400. We're lowering the balance in the receivable account because they're paying us most of that amount owed. They still owe us $1,600. Mr. Hassey, you make this look so easy when you do it. I took a look at this and I didn't know what the hell was going on.
Yep.
That's okay. Because it's just standard credit receivable, $4,400. April 25th, the company completed work for another client for $2,890 on credit. Notice we see no word of cash in that sentence at all. I don't see cash at all. I see we provided work for a client on credit. Debit accounts receivable, $2,890. Credit services revenue, $2,890. How do I know service revenue? They gave me the account. If you notice in the problem, they listed all the accounts you're going to use in this transaction. I do the same thing in quiz number 1. I give you all the accounts that you will use. April 28th, Tanner, the owner, withdraws $5,500 cash from the company for personal use. There's the key word, personal. That means it's not an expense. It's an
Withdraw.
owner withdrawal. Debit, K. Tanner withdrawals, $5,500. Credit, cash, $5,500. Taking $5,500 out of the business for personal use. Why personal use? He or she's the owner. They can do whatever they want. They're the owners. It's their money. But it's not a business transaction of the business. It's a personal withdrawal out of the company. April 29th. The company purchased $600 of additional office supplies on credit. Again, no mention of cash. I don't see the C word anywhere there. Cash. On credit. Debit office supplies, $600. Credit accounts payable, $600. And finally, April 30th. Thank God this is over with. We paid $435 cash for the month's utility bill. The month is over. The utilities have been provided for us. Thus, utilities expense, debit $435, credit cash $435. Ladies and gentlemen, you are now accountants. If you can record these business events in this general journal entry format, you are now an accountant. God save you. You have to post them to the general ledger. Remember step 2? Step 1 is to record the business transactions in a general journal entry. And then step 2 is to prepare the post to the general ledger. And here is my general ledger here. I'm going to stop right here and show you guys something. Stop right here. Account. One column for the date, one column for debit, one column for credit, one column for balance. And notice I'm summarizing. Don't worry about this post-reference nonsense. Ugh. They just do this to confuse you. But notice every journal entry, April 1, 2nd, 6, 13, 19, 22, 28, and 30, all involving cash, have now been posted to the general ledger cash account. And there's my cash balance at the end of the month of May or April, $59,465. Here's accounts receivable. Purchase twice, $4,200. Prepaid insurance once, $2,400. Prepaid rent once, $9,000. Office equipment twice, $34,000. So those are a listing of all our asset accounts and their balances at the end of April. The journals have been posted to the general ledger. Here's the liability. Accounts payable. Date, debit, credit, balance. $600 we still owe accounts payable. Owner capital, there's the original investment, $106,000 credit balance. Owner withdrawals, $5,500 debit balance. Service revenue, there are the 3 services we provided, $12,890. Utility expense, debit, $435. Those are all my liability and equity account balances at the end of April. And the final thing to do in this problem 2-1, and that's why this is so important, is then I'm asked to do the 3rd step of the accounting cycle. Take these balances from my ledger, which summarizes all the journal transactions, and lo and behold, prepare a trial balance. There's the listing of all the debit balances in my account chart of accounts and all the credit balance in my chart of accounts. $119,490. Thank the Lord. $119,490. The books are in balance. The general ledger is in balance. Each transaction is matching the debit and the credit. Does not tell me any financial information. All it tells me is that the books in the ledger are in balance. Blanca. All right. Chapter 3. Chapter 3 is all has to do with adjusting journal entries. All right? Adjusting journal entries. In other words, you have to adjust the accounts for certain things happening. One, as we've already seen, we haven't done the adjusting yet, but we've seen is what is a prepaid account. The prepaid insurance and prepaid rent of the last problem. With the passage of time, those insurance and rent services are being provided you. You're going to have to adjust the accounts. And why we adjust the accounts is because all accounting for corporations and businesses is based on the accrual basis of accounting. Revenues are recorded when products or services are delivered, and records and expenses are recorded as they are incurred. That's why we have a prepaid. Prepaid is we've allocated the cash, but the service hasn't been provided us yet, so we call it a prepaid. Then we do an adjusting entry to record that prepaid now as an expense. If we are on the cash basis of accounting, which is your son or daughter's lemonade stand at the corner of your street, a sale is a sale only when you receive cash. Expenses is only expense only when you pay cash. No, absolutely no businesses, legitimate businesses, are run that way. Everything is on the accrual basis of accounting.
Not even barber shops and places like that?
Not if they file tax returns. The IRS is not going to let them do it.
Oh.
Or if the barber, I'm going to probably say something that's going to offend somebody here, so I apologize in advance. Unless the barber shop or beauty salons are fronts for illegal cash flow and they're stashing their cash at these fronts of businesses. Then they're based on cash basis because they don't want anybody prying around in their records. Probably shouldn't have said.
You meaning
On recording when the service is provided, but look at here. Insurance expense is recorded over a period of time. As time expires, then we record the expense. That's what a prepaid's about. Also, we recognize revenues when the service is provided. That's what I was talking earlier about unearned revenue. Unearned revenue is you haven't provided the service yet. Like paying in advance to a lawyer for a retainer. You've given the money, but no service has been provided you. That service is owed you. That's why it's considered a liability. Unearned revenue. Revenue recognition requires that revenue be recorded when goods and services are provided to a customer at an amount expected to be received from the customer. In other words, you record the transaction. If no cash is traded hands, you still require the entry to be processed. The same thing with expenses. And here's an expensive quiz or examination type question you may receive. Why is expense recognized in the same period as the revenue that it created? It's called the matching principle of accounting. Anybody ever hear of the company Enron? One of the reasons why Enron got in big trouble is they recognized revenue first and then recognized the expense to achieve that revenue in another accounting period. That's a no-no. If I recorded an expense to provide revenue this month, it goes this month. I cannot postpone the recording of that expense next month. It's called the matching principle. A lot of companies get in big time trouble over that. Trust me, that's a big issue in accounting. It's called the matching principle. So this is the framework for which we have to do adjusting entries. There's 4 types of adjusting entries. The deferral of an expense, the deferral of revenue, the accrued of expense, the accrued of revenue. Those are the 4 types of adjusting journal entries. And here they are here. This is a deferred expense. It's called a prepaid. Prepaid is a deferred expense because we're deferring the expense until the service is provided us. All right. So when we have to make an adjusting entry, we have to debit the expense and credit the prepaid because now we're recognizing that the expense has been provided. Remember in the back of in chapter 2, we saw debit insurance expense, debit prepaid insurance expense, credit cash. In chapter 3, we're debiting expense and crediting the prepaid because now the service has been provided us. Here's the entry. There's the prepaid being made. And now we record the expense after every month. The prepaid insurance account is credited because it's a $2,400 prepaid for 24 months. That's $100 a month. We debit insurance expense $100 and we credit the prepaid $100. So there's still $2,300 left in the prepaid for 23 more months. So this is called an adjusting entry, called deferring the expense with the prepaid. You do this on a monthly basis. It's an example of number 1 adjusting entry. Again, remember, all these are located, these examples are located in your textbook, and you have the PowerPoint. This is the PowerPoint that I provide you in Blackboard. You can go over that PowerPoint and track and follow these as well. And also, here's a good helpful hint, is as you're doing these problems in a quiz number 1 or a midterm at home, when you have the luxury of spending multiple days on a problem, you can go into the PowerPoint or into your text and say, oh, that's how that's done. Now I can answer the quiz or the examination question. So notice the account balances at the end of that adjusting entry are appropriated. And there it is right there. And there it is right there. Journal entry and posting to the ledger. Here's another one. This is adjusting journal entry number 2, deferring the expenses because we purchased supplies in advance. A company purchased $9,720 of supplies in December. Some of these were used during December. At the end of December, we take a physical count of supplies and find that there were $8,670 worth of supplies in our shelves. There's the entry for the purchases. And now, because of the difference between the original purchase and what was left over, we have to do a journal entry recording the adjustment of supplies being used as an expense. And there it is right there. The difference between $97.20 and $86.70 is $1,050. Thus, we have to do an adjusting entry to lower the balance in the supplies account by the supplies that were used during the period of December. And now we begin the next period with $8,670 of supplies yet to be used. 1, prepaid. 2, supplies are examples of adjusting entries. Here's another one. It's called depreciation. No, it's not called depression, but depreciation does cause depression. Pretty good, Cynthia, huh? Purchased, we allocate or spread out the cost over their expected lives. It's called depreciation. We take the asset costs minus the salvage value determined by the life of the asset, and we determine the depreciation. So let's say we purchased $26,000 of office equipment, which has a life of 5 years and has a value at the end of 5 years of $8,000. Now, where in the hell am I supposed to get those information if I'm an accountant? Well, in this class, it's given to you. But in the real world, anybody ever work for a company that has purchasing agents? Purchasing agents? Yes, Jessica. They probably were the robbers that sold you the damn gift cards. But purchasing agents keep track of the assets. They buy the assets. And they know through their vendors what's the estimated life of that asset. They know through their vendors what's it's expected to be worth after you beat it up for 5 years. Purchasing agents figure that out. If you don't have purchasing agents, your accounting firm of Dewey, Cheatham, and Howe, the public accounting firm, Dewey, Cheatham, and Howe, they will figure out that information for you. I have a chat question. Let's see what it is. And it's mounting. 4 of them. Holy moly. We were having echo there. People are getting worried about echoes. You're bothering me over an echo? So $18,000 divided by 60 months means we have to depreciate this asset for the next 5 years with an adjusting entry every month for $300. And there it is right there. We debit depreciation expense and we credit accumulated depreciation. Notice we don't credit the original equipment account. The equipment account stays there because it tells the world that's how much we paid for it. This account here is a asset account with a credit balance. If you want to impress somebody, it's called a contra asset. But I wouldn't write that down. You're not going to be tested about that. It's an asset account with a negative or a credit balance. So on the balance sheet, it would say equipment, $26,000, less accumulated depreciation, $300. And the expense is the expense for the period of time of 1 month of depreciation. Prepaid, supplies, depreciation. All examples of adjusting entries. And that's how it looks like on the balance sheet. And here's the fourth, or one of the key adjustings, is the deferral of revenue. Remember when I said earlier, when you pay a lawyer in advance, it's called unearned revenue. It's a liability. You credit the liability of unearned revenue and you debit cash when you receive the money. Now, as unearned revenue and the service is provided, you will debit the liability of unearned revenue and credit revenue. It now becomes actual revenue because the service has been provided. People do this for a living and get paid very well for it. So here's an example. This company's client paid a 60-day fee in advance. Okay? 60-day fee in advance. $3,000. It's for 5 days. So that's 5 days service is earned at 3,000, they paid $250. So you're now going to record, there's the recording of the paying in advance. They receive the cash and they have a liability, unearned revenue of $3,000. Then $250 is paid as the service has been provided at the end of the month. So now we do an adjusting entry to record the liability now being used up as revenue, debiting the liability account and crediting revenue because 1 month, $250 has now been earned of that amount we paid in advance. And then we have another example of an adjusting entry. Remember, prepaid, supplies, depreciation, unearned revenue. Now we have what is called an accrued expense, where an expense, a service has been provided you and it remains unpaid. In other words, somebody provided us or somebody worked for us for a day. You guys know this. Let's say you get paid and your pay period ends December 31st. You're not going to get paid until the next Friday in January. So as of December 31st, it's an accrued expense. You've provided the service of salary, but you're not going to pay it until the next accounting period. Debit salary expense, credit salary payable. That's called an accrued expense. A service has been provided, but it won't be paid until later on. Cynthia's had about enough of this nonsense. She's getting a headache. And there's the recording of that. All right. And the same thing holds true. This is the last one. The same thing holds true for revenue. You have maybe provided a service, but it remains unpaid. You provided a service, but it remains unpaid at the end of the month. You debit accounts receivable and you credit revenue. Hey, at the end of the month, I did this work for you. You owe me the money and I provided revenue, but you're not going to pay me the money until next period. It's called accrued revenue. So here we go. The big six: prepaid, supplies, depreciation, unearned, accrued expense, accrued revenue. Those are all examples of adjusting journal entries. Okay, we'll practice a problem involving adjusting entries in our weekend update video later on this week. But the task at hand this week is to begin your assignment number 2, prepare journal entries, trial balance, and financial statements for the month of May for the company included in assignment 2, all on the worksheet spreadsheet that I've provided for this assignment. Again, all work is done on that spreadsheet. You post that file to the assignment 2 file folder. I have posted the grades and the solutions for assignment 1. If you have any questions, I'll be available tomorrow evening, Thursday, for any questions to review that assignment. And look for my video on Friday to look more into chapter 3 and get prepared for assignment 3 for next week. All right, everybody, have a great week. We'll talk to you in a few days. Adios.